What is the yield curve in monetary policy history? Imagine a line that tells us how interest rates change as loans get longer or shorter. That line is called the yield curve. It shows the relationship between interest rates on government bonds and how long until they mature. On the bottom, we see the time to maturity, from 3 months to 30 years. On the side, the interest rates or yields. The shape of this line can tell us a lot about what investors and central banks expect for the economy. In the past, the yield curve has been a key tool for understanding economic health. When the curve slopes upward, with longer-term bonds paying higher interest than shorter-term ones, it suggests that the economy is expected to grow. Investors believe inflation might rise, and they want a premium for locking in their money longer. But if the curve flips upside down, with short-term rates higher than long-term rates, it often signals trouble. This inverted curve has been a warning sign of upcoming recessions in many cases. Central banks watch the yield curve closely. When they raise short-term interest rates to fight inflation, the curve can flatten or even invert. This shows that markets expect slower growth or even a downturn. During times when central banks lower interest rates to boost the economy, the curve usually steepens. This steepening indicates optimism about future growth and inflation. Sometimes, central banks directly influence the yield curve with policies called yield curve control. They set targets or limits on certain bond yields to keep borrowing costs stable. During and after World War II, the United States Federal Reserve used these policies. More recently, Japan and Australia have adopted similar measures to help their economies grow and keep borrowing affordable. Overall, the yield curve acts like a thermometer for the economy. It reflects what investors think about future interest rates, inflation, and growth. It also shows how central banks' policies are shaping the financial landscape. By studying the shape and movements of the yield curve, we can get a clearer picture of where the economy might be headed and how monetary policies are working over time.